and welcome to this episode of OmniTalk. Today we are discussing one of the latest growth vectors that we wanted to discuss with you all, and it's from the banking sector. Hi Vikas. So we are essentially banking on the growth of the banking sector,
Right.
and we want to discuss that on various parameters, including the fundamentals, including the valuation, including the growth outlook. Why we think that it's quite an attractive investment opportunity for investor to look at this time. Obviously, there are so many things that are happening when we talk about markets broadly, but this particular sector is something I think which is very nicely poised from the future growth and the current valuations and the strength of balance sheet or the strength of fundamentals. I think we'll immediately delve into that in more details. So let's start with fundamentals, because
Sure.
banking is typically a tricky sector, especially uh, you know all growth may not be very good. There are issues of NPAs.
Correct.
There are issues of sector exposures,
Right.
and it's very easy to give out money, but how do maintain a lot of prudence in that, and as as a being very conservative following the scientific investing framework,
Mhm.
how do we see banking today, and how do we go about to even thinking about investing in banks being a little tricky space.
Right. Right. So even before that, see, one thing is that the whole, when you're saying banking on the growth, actually the whole economic growth is driven by banking, right? I
True.
mean, that's providing the capital for growth.
Absolutely.
So that's one sector which impacts all the other sectors practically.
Hmm.
Right. So that is one interesting thing to keep in mind, that when you're taking exposure to banking, you are taking exposure to the whole economy.
Absolutely.
Now coming to this, like maybe 5 years back, we didn't like banks at all, right? There were two reasons. One was I mean, both the private sector and the public sector had NPAs,
Right.
and pretty significant NPAs. But on top of it, the public sector was really bad,
Correct.
right? It was extremely bad balance sheets,
Hmm.
very weak balance sheets. There was no way they could grow, and they had to shrink. Right, that was one, because of the capital adequacy and all that. Even in private sector, the growth was happening, but there was continuously a lot of NPAs being taken care of.
Correct.
And if one or two banks in private sector were having relatively cleaner balance sheets, then the valuations were very, very high.
Because if you had to take exposure to banking, these are the only 2-3 names, and
Right.
everyone was chasing that.
Right. So overall, it was not worth investing in banks. Today, and the whole of Indian economy was struggling about 5 years back, 2019 or something. They were struggling for growth. Right, the economic growth had hit a bottom of 5% for one quarter or something, and that was primarily because of the twin balance sheet problems. Right, that the corporate sector had borrowed too much, so they didn't have capacity to borrow. In fact, they were not able to repay. Right, and so on. And on the other hand, the banks couldn't lend.
Right.
So this was the twin balance sheet problem, which was no credit growth, lower economic growth, right? A natural outcome. Now it's exactly the opposite situation. Corporates have a 15-year low, as far as especially manufacturing sector is at a 15-year low on leverage.
Right.
It goes as high as 1.2 debt to equity. Right now it's about 0.5.
Yes.
Okay, on the manufacturing. And even if you talk all the non-financial corporates put together, they are very low.
Yeah, it's still around like 0.6, 0.7 times, right?
Yes.
So it's pretty low. It used to be, normally it used to be more than one. And I think after COVID, or that whenever that deleveraging cycle kicked in, a lot of corporates have significantly delevered, and the numbers are very, very comfortable.
Exactly.
To take on that next cycle of capitalization.
And the demand is there.
Right.
The consumer demand is there. The industry demand is there.
Right.
So the companies are now again have started to invest. They will use some internal accruals, and they'll have to use a lot of borrowings, as well as some equity.
I think the last year, at banking advances grew by 17%. So already that growth has
Growth
started
is
kicking in.
already
Already
started,
started.
right? So the demand is there, growth has already started. Now come to the banks. Can they lend?
Right.
So we discussed that the banks' balance sheets are clean, everything is fine. But the important number is the CRAR, right?
Right.
The RBI requires it to be approximately 9%. It is today at 14, 15, 16%.
17% last, like March 23, it was 17.3. Yeah.
So it's very high,
Really, yeah.
right? It's very high, which means the capacity to lend is very, very high.
Right.
And the banks will not have to raise any equity capital or anything for growth.
Correct.
Just the existing capacity should be sufficient for them to keep nearly doubling,
Absolutely.
right? Their total balance sheet without borrowing at all.
Correct. So I think that, like, obviously there is demand and there is ability to supply whatever credit the industry now requires. In terms of banks' own fundamentals, I think their ROEs have been improving significantly. But do you think there is more room for further improvement?
Yeah. So see, broadly, public sector banks go to 25% ROE at the during the economic boom, right?
Right.
And private sector, in public sector should be around 17, 18%. That is the typical understanding we have. Uh, so today the public sector is still, lot of public sector banks are below 10, right, single digits. So you can clearly see an opportunity to at least double the ROE, which means the earnings accelerate very, very fast, right? If that happens over 3 years or something. Secondly, coming to private sector, again private sector is below 20, right? 17, 18, 16 and so on. And if it can go to 25, that's again more than 50% kind of a growth opportunity.
And I think the pressure from the NPS is also at going to be low, because
Absolutely.
I was just looking at the gross NPA is around 3 point something, but the net NPA is 0.9, it's less than 1. So further provisioning, so earnings going into further provisionings will be much lower. So
Exactly.
the ROE enhancement
improves.
will be much significant.
That is one driver.
Right.
That is probably already played out significantly, but still, I agreed, there is some room there. And then the operating leverage, right? That with the same expenditure structure, operating expense structure, they can lend much more.
Sure. So great. So I think the fundamentals are good. Growth outlook is strong. And overall, the capex expenditure we have been talking about, it's very strong. The Indian economy, like in the budget last 2 years, 13 lakh crore, this year 17 lakh crore.
Right.
So it's pretty significant compared to the total, advances of banking sector, which is around 150 lakh crores. So a lot of growth is coming from that side, which will continue to come, let's say, for many years. So that side is also, broadly adds up to, the ground up analysis that we did. Let's talk about the valuation. How do you see, attractiveness there?
Yeah. So valuation wise, again, I mean, so normally you have to look at price to book, right? That's what normally people say, price to book for banks. And price to book of 1 is fair value. However, we have to keep in mind that in India, banking is a more oligopolistic, right? Monopolistic business. So there are fewer banks and there is much more demand. And everyone has to, take care of their borrowings from these limited number of banks. So there is a mismatch in that sense. And that gives them the opportunity to earn much higher on the equity or on the capital, right? So because of that situation, it's more relevant to look at PE ratios rather than the PB ratios. Okay, and if you look at the PE ratios, then the private sector is also relatively cheaper, and the public sector is also relatively cheaper. I mean, it's in fact it's really cheap.
I'll just quote some numbers. While the broader market Nifty 50 or mid cap small cap indices valuations on PE multiples are somewhere around 24 to 28, 29. For public sector banks, the P multiple as an index, so there's a Nifty index on public sector banks. The PE is at 10. The private sector Nifty bank index, the PE is at 70.
17, 1
Yeah,
7.
1 7. Yeah.
And even if you take the public sector and remove SBI, SBI is what PE of approx
I'll have
but
to check.
this is
But this
dominated
is
by
dominated.
SBI
Right.
basically,
Right.
right? So if
Right.
you take it out,
Out.
then it will definitely go to single digit,
Single digits. Right.
right?
Right.
So that is like one is growth is coming.
Right.
So that's the basics, like 15-20% nominal growth rate, which is
Correct.
already happening, right? You said
Yeah,
last year 17% credit growth rate. So it's a 15 to 20% kind of growth rate. Then the valuation,
Right.
okay. Then the ROE,
ROE.
which increases the acceleration in earnings
Earnings. Right.
beyond the growth rate of the
Fundamental growth.
revenues,
Right.
right?
Right.
So this is how there is a really large opportunity here.
Right.
And on a very broad scale, macro level, also there are reports from various investment banks, research banks, where people are saying that the Indian total investment is going up from $1 trillion annually to around 2.4 trillion by end of the decade. Right?
Right.
So the gross capital formation or the total investment, which the banks will get some portion of. Something will come from government, something will come from bonds and other things,
Right.
FDI, etc.
Right. Right. Great. Yeah, so that's what we want to bring to the fore, and that's a very attractive and hidden in plain sight, I would call it, because this is
Absolutely.
the largest. This is one of the largest sectors,
35%
of
of
the
Nifty.
Nifty. So there is a great opportunity in plain sight, hiding in plain sight. So
Yes.
something to talk about. Very we have always found such hidden
Yes.
growth vectors,
Yes.
and obviously, like with as market, Mr. Market realizes this and then reprices, will hopefully will happen in next few quarters. But this is something that we are finding very attractive today. Any anything else, Vikas? Or
No, it's just I just wanted to observe that as part of scientific investing, it is always fun to
Yeah.
find out where Mr. Market is making a mistake or is
Right.
ignoring something.
Right.
And when it is as obvious as one of the largest sectors and the
Right.
core sector like banking,
Right.
then it just feels exciting and good. That's all.
Correct. Great. Okay, great. Thanks for tuning in. Thank you.
Thank you.
So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing, and also that registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.